Hey everybody, welcome back to the Investing Education channel. So today I wanted to talk a little about some of the qualitative metrics that you can look at when you're looking for great companies. So like I mentioned, I think the moat really is the most important criteria when you're looking for a good company, and I've done a separate video on moats. But that can be a little bit more of art than science. So how do you find or how do you analyze the mode in terms of some numbers? So that's the purpose of today's video. So I'll go through a few points. The first thing I would look at in terms of companies, I do tend to look at their margins. So I look at gross profit margin, I try to look at operating margin, and I try to look at EBITDA margin. So on the screen you have a few companies. So as you can see, MasterCard has gross profit margins that are really out of this world at around 81%. They operate in a duopoly, right? So and also that the margin, the gross profit margin actually tells us about the structure of the business. Is it a capex light business or is it a capex heavy business? So you can see Visa is definitely a capex light business. Not a lot of money is used to actually run the business, and 80% of that is gross profit, right? On the other hand, you can see Boeing. Boeing has about 20% in terms of its gross profit margin. So quite a big disparity. I'm not saying that Boeing is a bad company, and I like Boeing for other reasons, and I own it as well. But you can definitely see, which is the better company in terms of the capital structure here. Another thing you can look at is the operating margin. So this really comes to the crux of the issue in terms of the profits, right? I don't tend to look at the net profit margin because I feel net income can be manipulated quite a bit. So I rather look at the operating margin. And here again, you can see companies like Visa and Master, they really have very superior kind of operating margins. Again, their structure is capital light, so a lot of the revenue really just goes down to that bottom line and it's pure profit. I do tend to also look at the EBITDA margin because I think that gives you a better idea of the cash flow through a company, and I think cash flow is very important. So here again, you can see consistent with the other margins on top, Master and Visa really have very superior kind of EBITDA margins, and Boeing is much lower at about 14%. So this is an important criteria. I wouldn't say it's the be all or end all. I still own Boeing and I own it for other reasons, but margins are very important, as you can see. The margins also tell us a little about, I think, the industry they're in, and also in terms of the competitors that these companies have. So basically, if you have very few competitors, you can raise your prices, right? And so that's why companies like MasterCard and Visa have very high operating margins, because they can raise their prices and there's no real competition really. It can also tell us a few other things, as in terms of what are the costs associated in running the business. We've heard about Facebook's operating margin going down because initially they're running the business without taking too much care about security and privacy and stuff like that, but now they're investing much more heavily and they're finding out what's the real cost of running their business. So although their margins are quite high, the margins are going down a bit, and over time we'll get a better sense of what are the average margins in their industry. Another important quality metric, I think, are the return metrics. For example, return on equity, return on invested capital, and return on capital employed. I think return on capital employed is probably the most important because it measures operating income over the shareholder equity and the long-term debt of that company. So it really measures it, in terms of the pure cash flow of the business, and also the total capital structure, which includes equity and debt. I'll go into maybe the details of some of these metrics in another video. But for present purposes, the higher the number, the better, right? So again, you can see a company like Facebook. And generally, I think a company that has above 20% in terms of return on equity or return on capital employed is generally a good company. And you can see some of these companies have very high return metrics. Facebook consistently above 25. Alibaba is a bit lower, although it looks a bit better on the return on equity. But Alibaba is investing a lot, so you can expect its profits to be a little lesser, right? But over the long term, it will probably go much higher, I think, especially when some of the competition, fades away. You can see Booking, which also operates in a virtual duopoly with Expedia, also has very high return metrics. I think another important thing to look at is also the cash flow growth over the last few years of a business. For example, if you look at Amazon, right? And I'll just go scroll down over here. I mean, revenue growth is one thing, and that's great. But cash flow growth is very important as well. And you can see here over the last 5 years, the annualized growth rate has been about 44%, which is absolutely amazing, right? And you can compare that with another business which has not been doing too well, and is reflected in the stock price, and that's IBM. And if you scroll down, you see, I mean, revenue growth has been stagnant, but cash flow growth is even more worrying, and it's been decreasing at 6.7% per annum. So you see a lot of warning signs when you look at the cash flow decreasing, and cash flow is really what sustains a business. It's really like the lifeblood of a company. I think another important factor that you can look at is also the culture of the company. What people think of the company and what the employees think of the company. And I have on the screen something from Glassdoor which shows what basically the employees of General Electric think about the company. I mean 83% may approve of the CEO, but you see, it seems their business outlook is very, very dim. I mean, only 36% have a positive business outlook. And you could compare that with a company like, for example, Microsoft. They have a higher CEO approval, but more importantly, the employees at least think their business is more sustainable and has a much more brighter future. So that's also another clear indication that you're on the right track when you're choosing a company. So I think those are some of the qualitative metrics I look at. Are there other quality metrics that you look at? I'll be very happy to know about those as well. In terms of the real money portfolio, is doing well in the beginning of April as well. I mentioned I bought a bit of Boeing in March. I do plan to buy more Boeing if it falls into the 330 range. So let's keep that in view. So everybody, thank you for listening and have a great day.